Okay, welcome everybody. Thank you very much for joining us today. So, just doing a quick test here. Last week we had some technical difficulties. Seemed I have some type of connection problems at this Airbnb, but it actually looks pretty good. So, neither here nor there. I'm switching Airbnbs again. This will be the seventh time I've switched Airbnbs in the last 2 months. As I mentioned previously, I'm in Dubai and I'm trying to just stay in every little area that I've never stayed in before, just experience them all before, possibly starting to maybe invest in some real estate here, get a couple of places. But, it's always good to experience it firsthand, get out there and actually run the neighborhood and really see. So, yep, switching again next week. Background will change a little bit, but it actually looks pretty good. So, yeah, we're good to go. Good topic today. This is actually right around the time where I do start to get quite a few emails talking about updating the spreadsheet. This is what, of course, we'll be talking about today. But just a quick reminder about the spreadsheet. I do update it quarterly, so we will do these live streams just specific to the spreadsheet quarterly. But I do want to let everybody know how to get the spreadsheet first. That'll be the first topic. Then I'll go in it and I'll just show everybody what it is, say a few things about it. And then sort of the idea here is not only to give everybody really valuable volatility data, but also every quarterly update. The plan is to add a little something to it, a calculator here and there, some additional data, and start actually running some numbers and crunching strategies and whatnot, and sort of exchanging ideas back and forth. That's the idea. So over the months and years that we do this, that spreadsheet should expand and be pretty extensive, hopefully. And obviously, feel free to give suggestions on what you'd like to see. Doesn't mean I'll add it, in the next quarter, but I'll put it on the list. There's quite a few things that I could add, but of course, A, don't want to overwhelm everybody, and B, we got to, keep it moving every quarter to do something new. So I'm not just going to, blast everybody out there with everything already. So get your suggestions in. And then part two, I will actually go over the new edition for the next quarter. And it's pretty cool little calculator that I think people can mess around with for a few minutes, give you some short volatility trading ideas. So with that, of course, as always, my live streams are free. I don't run them, with advertising, and I don't take breaks here and there, but it would be very much appreciated if you could give it a like. And most importantly for me, of course, is to just get the work out there. So if you're on Twitter, if you're on social media somewhere and you see my posts, make sure that you share it, just forward it to people who you think might enjoy this type of content. There's not very many places you can go to just ask open questions, of course, for free, don't super chat or anything. And no moderators, we're just hanging out. Ask me absolutely anything. I am an open book. So let's get started. Okay, so like I said, I've got a data spreadsheet. And first of all, I think what people need to realize and hopefully appreciate is that this data is not so easy to come by. But if you are going to be a volatility trader, I do think it's somewhat mandatory. Now, I will talk about the limitations of doing back testing and how far that can really carry you. But of course, not having any underlying data for the volatility stuff, you're kind of just bumping around in the dark. And I'm really not sure how people manage and navigate forward without at least a baseline spreadsheet with a bunch of data in it. So, interestingly, my comment section seems to be turned off at the moment. So, before I get into this, just for anybody who's listening right now, either on YouTube Live or on Twitter, X, whatever, I still call it Twitter, just put something in the comment just so you can actually hear me. I don't want to be yapping on here and then realize in 30 minutes there's some technical difficulties. So just shout out in the comments if you can hear me and see me. That would be very helpful. But like I said, I do update this spreadsheet quarterly, so you can download a fresh new copy every quarter. Or what you could do if you're, decent with Excel, you could keep your baseline spreadsheet that maybe you're making some alterations with over time, and then every quarter download the new one, but copy and paste anything that you actually need. That would be one way you could do it. Or maybe you don't need me anymore. Once you get the initial spreadsheet, of course, then you could fill it in yourself. That would be the ultimate. If you just took the work and you said, okay, well, that's good. But every month, every day, now I'm going to be adding the VIX futures. I'm going to be tracking the volatility ETPs. You could do that as well. But certainly you can just come back and download a new copy every quarter and use it however you want. So how you are actually going to do this, I do say it's a free spreadsheet, and it is free, but bear with me. I am also running a business here. So everybody kind of has their thing to get people to either give a name for a newsletter or subscribe or something. So I've somewhat done the same. So if you go to the website, volatilitytradingstrategies.com, you should have probably at some point, if you watch my work, you would have already landed here, but go to the subscribe tab and sign up for the free 2-week trial. So everybody gets a free 2-week trial. You're not charged for a couple of weeks. And once you do that, you're going to get a welcome package that there's an email that comes to you every day. And it just explains sort of the very basics of my work, the strategies and whatnot, how they interact with each other. And in there is also a link for the spreadsheet. So you can download it there. And it's just, click of a button, download your spreadsheet. And when you do that, it will look like this. So the first thing I'm going to do is actually go over it really quickly here. I've done this a few times before, so it might seem like I'm just ripping through it and not really stopping it anywhere. But of course, as we go on in the future live streams, if you want me to slow down and explain something, I certainly will. So the first page, this is a course, the start of a course. This is going to be at least 30 or 40 videos here, but every one of these little screenshots that you see is an actual video. So if you just click, I've got it on mute right now, of course, because it has some background, but all you do is basically click on each one of them and you can watch them in order. So this first course is my volatility landscape course. This is all about the volatility ETFs. So this is not specific to the VTS portfolio. This is for everybody. Everybody would benefit from this, whether you're trading by yourself or you are part of the community. I would suggest you go through them. And currently right now, how many is there? There's 8 lessons. Talk about Volpocalypse, talk about what beta slippage is, talk about the roll yield, of course, why that's so important, all of these things. And the only thing I would say is suggest to you, if you're in the community, you get to go through the actual course and it tracks your progress. So you don't have to do this. But if you're not a paying subscriber to VTS, that's just fine as well. I would just say that every time you watch a lesson, just go ahead and turn the cell green, just so you know, and try to get to a point where you've actually turned all the cells. That's the first course. And then the second course, this does get specifically to the VTS portfolio. And this is what we call the Total Portfolio Solution course. You can go through these as well. And again, same thing. I would always suggest that once you watch the lesson, click it green. Doesn't mean you can't go back to it later on, but at least you know and you're tracking your progress. So that's that course. But essentially, here we are inside the spreadsheet. This is data updated through June 2025. And this, of course, goes back all the way to March 26, 2004. The reason it goes back to this rather odd date is because that's when the VIX futures launched. So for me as a volatility trader, pretty much all of my data goes back to 2 dates. It goes back to either March 26, 2004, or there are times when I would go back to either 1986 or 1990, sort of back to the original days of the VIX index. But a lot of the work goes back to 2004. That's why it starts here. So we've got the VIX futures. This is, of course, extremely valuable if you are a volatility trader. You need this data, and it's not so easy to get it. So I'm happy to give it to you, basically for free. Sign up for the free 2-week trial. If you happen to only want the spreadsheet and nothing else, of course, there's plenty of other things to learn, but then of course, just unsubscribe. And if you happen, look, I'll just let everybody know, I'm not running this as an advertisement. If you happen to forget to unsubscribe, don't worry about that. I offer refunds, no questions asked. It's no problem at all. So just do the free trial and then you can decide what to do with it. But I talk quite a bit about the cash VIX term structure. This is the VIX 9-day, right? Everybody knows what the VIX index is, or at least vaguely familiar with it. But there is also 9-day, 3-month, 6-month, 1 year. And these are very, very important. The cash VIX term structure is, while I wouldn't say it's sort of a centerpiece of our work, we certainly do talk about it quite a bit. And the structure and the shape and how these are moving around, the different momentum changes between these two, whether you're seeing a lot of front end movement and very little back end movement, that means something. If you're seeing the VIX to the VIX 3M doing some, interesting things, that could be indications of whether what's going on in the market is more front end heavy, more news related, or whether it's actually structural. If you start to see changes back here, you know that the market is actually absorbing some significant events. If all the action is being front end, then it's probably just news driven day to day. It's Trump doing Trump things, all that. But this is also very, very important stuff. So you get all of that going back as far as the data goes, right? So we don't have all of them back. Somebody like Vance Harwood, for example, I haven't looked in a few years, but he does occasionally go back and run the numbers. I used to do that. That's how I get most of these other, volatility data. I used to run those numbers, but to be honest, I haven't in quite a while. So I don't have the VIX 90 going back, but we've got it until the dates that are relevant. So tracking the changes of this is super valuable. And then, of course, all volatility ETPs, VXX, UVXY, everything you've ever heard of, they do actually track underlying indexes. They are not based on supply and demand movements. So they're not stocks. They don't move like stocks. It's not like a whole bunch of people are buying VXX and that's why it's going up. It has nothing to do with that. They all track underlying indexes. And if you just hover on them, each of these underlying indexes has specific volatility ETPs related to it. So, of course, you've got that data. This is valuable to have. There are times when you might want to just measure these rather than the volatility ETPs if you wanted to do that. But then, of course, you've got the data going back as well. And for back testing, honestly, of course, how would you even back test something if you don't have the data? Many people don't have this, so this is good. And then we've got crypto stuff. I, of course, am, I've made no secret of the fact that I am sort of bullish crypto in general on terms of price. I have been for years, bullish on crypto for years price-wise. But, if you follow me on Twitter, you will know that value-wise and usefulness-wise, certainly when it's discussing about a currency, I'm very bearish on crypto. So I trade Bitcoin. I trade crypto. I don't invest for the long run. I'm not a full believer in the story, so to speak. I do think that a lot of this is just the situation with a lot of people just being forced into risky assets for, no other thing to invest in really. So crypto's just exploding in the last few years. Wealth inequality, lack of real income rising, inflation, all of these things are playing a role. So I trade crypto quite actively. I have a Bitcoin strategy. It will at some point be introduced to our upcoming VTS options community that will be relaunched. I will, of course, find a way to introduce the crypto strategy for everybody. This is sort of my main one, tactical rotation. I will very likely just explain exactly how it's done and actually give you the entries and exits formula so you don't require me anymore. You kind of get the formula and then you're off to the races and it's your strategy. So I will very likely do that. That's coming. And then there's some other data here as well. So we've got VIX futures data, which of course, everything is fundamental to the VIX futures. And then you want to expand from there. So once you understand all of this and you kind of have a good gauge of where the volatility ETPs actually derive their price, then you can move on to other things. But this is sort of entry level step one. VIX index going back to 1986. It's very interesting to see sometimes that glaring, 1987 move where it went to 150. Stocks, bonds, gold. I always think that it's good to have a valuable benchmark to compare your work against. So if you're doing back testing, what is considered good? When you come up with a strategy, what is good, right? Of course, you would want to beat your benchmark on both an absolute return and also a risk-adjusted basis, right? You would want to beat the number overall, and you would want to have lower drawdowns. So we've got stocks, bonds, and gold going back to 1990. And I have gone through this spreadsheet, and these are trading days, right? So you can just copy and paste this to anything else, any ETF, any mutual fund. You just match it up directly, and it's going to be the same for everybody. And then a benchmark, 50, 30, 20 is pretty representative of what most investors do. The number is going to be plus or minus 1, basically. So this is sort of the standard benchmark that I would say most people, you should try to beat this. And given that it's going to, if you're a tactical trader, right, if you're like me, that you're kind of in and out of positions, of course, you will be subject to short-term capital gains. So you would not only want to beat that, but you would want to beat it by probably 20% higher. So, if your benchmark is making 7 to 8%, you're going to want to make 10% a year minimum as you're active trading, because there is a small percentage there difference between short-term and long-term capital gains. So that is, of course, a good benchmark to use. And, you can see it here. It's not overly impressive, but there it is. If you can beat that, then you're probably better than 90% of hedge funds. You're certainly 95, probably 98% of individual investors. And that's the whole point of having data, is that you're going to be building strategies that try to beat that. We've got crypto data, obviously very important. And again, with crypto, it is important to point out that this is trading days. Obviously, crypto trades daily, but I have gone through back and removed all non-trading days, and I'm only including data so people can just copy and paste directly. Inflation, not overly important, but you've got the data anyway. And of course, benchmarking, subtracting inflation is always important. A rate of return in 1980 means something very different than a rate of return in 2025. The glory days when people say, oh, such and such investor made 20% a year in the 70s and 80s. Well, I mean, is that even better than inflation? Hard to tell. So of course you want to benchmark everything versus that. And if you want, you can watch a video on inflation, right? Everything that you see a picture in a spreadsheet, this just means that there's a video attached to it. And then lastly, in orange, this is where the calculators are going to be. And I'm, like I said, the plan is to add a whole bunch more. So the first one that we introduced last quarter was the VXX calculator. So we can see the price. I believe the last I saw it was about 46. So, you can just type that in and everything is going to change. So what this does, you can just see the natural decay factor, say over 30 days, over 90 days, over 3 years, just in case you're the type of person that's going to be doing option trades. It is a good idea to have an indication of what the long-term average is. So if you're doing a weekly VXX trade, if it's at 46 today, strictly based on long-term averages, it decays 0.246% per day. Well, it's useful to know that in 1 week, 5 trading days, it should be around 45.40. In 10 trading days, 2 weeks, 21 days, that's a month, it should be down about 43.68. So if you're setting up options, you're doing butterflies or calendars, you at least know where your strikes are somewhat supposed to be positioned. Now, obviously, if you think it's going to decay more than that, well, I shouldn't change this, or less than that, that'll change things. But at the very least, have a basic benchmark. This is not the end all be all. And then that gets us to what I'm going to talk about next, which is the new edition. And this was an idea that I had because somebody in a previous live stream basically shared their basic volatility strategy, right? It's nothing groundbreaking, but somebody said, hey, this is how I short the VXX. These are the basic rules that I follow. And so I added a calculator so we could actually talk about that. Okay, so the question, first of all, and you'll sort of understand what I mean here. Let me just minimize some of these. The question that was asked, not really a question, he said that the short strategy that he's been using, can you see that? I'm not sure if you guys can see that. Let me just make sure, reset everything. There you go. Now you can see it. Essentially, they're saying that the strategy goes, you short the VXX when the VIX index is between 18 and 30. Otherwise, you would be in cash. So if you go to the new calculator in the spreadsheet after you've downloaded it, you will come to this page. And we've got the VIX data and we've got the VXX data. This is really all we need to test this strategy. We're going back to March 26, 2004. So we've got the VIX, looks like this. You can see that the mean is 19, the median, all of the data basically there. Percentiles, if you prefer to look at it this way. And then we've got the VXX the ugly downward chart that we've all seen before, that everybody looks at this and they say, well, why don't we just short this thing and everybody will make $1 million? It's the easiest thing in the world. I'll explain in a few minutes why this isn't actually the chart of the VXX, but this is just the price chart. It's not relevant to traders, but it certainly gives people the idea that you just short it and you make $1 billion. But essentially, hopefully people can see this, but I've done a little write-up here. I'll read a little bit of it. It basically says, I often hear people say this strategy is to short volatility when the VIX index is between a certain range. As their theory goes, when the VIX gets too high, that's a red flag and a signal to close the position and move to safety. Agreed. Also, when the VIX goes too low, that may be a sign that the market is getting complacent and time to move to safety. Also agree. So you basically play the short VXX trade in between that range. And then I go on to say, I don't disagree. My VTS strategies are actually, sort of tangentially based on this concept that if you really think about what he's saying, when volatility gets high, obviously the market is crashing. So this is not a very good time to be short the VXX. I mean, yes, there are times when the contrarian can time it perfectly and just nail that top. But what happens most of the time is that you get in too early, the market crashes, and you can bleed an enormous amount of capital very quickly if you short volatility when volatility is high. So it makes sense to cut the top and not trade there. The other side of it, the low side, about the complacency end, it also makes sense that once volatility gets to a certain lower range, well, at that point, it's going to be hard for the market to keep going. It's probably already been on an extended streak for a while, and maybe the next pullback is just around the corner. So bookending those two things does actually make some sense. So when the person said that, that's the strategy, is you essentially just pick those two bookends and you only short the VXX between them, this does make some sense. So let's go look at that. So what I've built is a very basic calculator, low end threshold here, and there's explanation on how to use it if you need, but 18 and 30. And then on the right is going to show what that performance actually was. So the first thing I'm going to do is basically just buy and hold. If you put both of them at 0, this is buy and hold the short VXX. This is what it looks like. Why didn't that update? Come on, update. Why didn't it update? Hold on. Troubleshooting here. What in the world is going on? This whole live stream is going to be ruined if this doesn't update. Well, folks, am I already dead in the water here? This is an absolute disaster. Let me close this. Don't save. And let's try to salvage this on the fly for everybody so I don't completely embarrass myself. I hope that this is going to be fixed when I reload it. So, okay, that looks good. Let's see this. Okay, seems to be working. I'm an idiot. I put 0. Sorry. I'll just edit all that out if I ever repost this. 0 to 100. Of course, 0 to 0 means 0. What is wrong with my brain? Sometimes on a live stream, you just do the dumbest things and you can't figure it out, and then you realize it. So obviously, 0 low end, 100, this is buy and hold. So here we go. Let's just pretend that didn't happen. This is the performance of short VXX buy and hold. Now, this is where I said that, well, wait a second. I thought it looked like this. I thought the VXX just goes down forever. What's going on? Well, the truth is you have to daily rebalance, or at least regularly rebalance, because when you short something, and I should probably do a full live stream in the future explaining this, but when you short something, obviously you can only ever make 100%. And short VXX has the potential, and hopefully all of you out there are trying to make 20 or 30% a year when you're shorting volatility. Well, yeah, sure, you can short the VXX in a very small amount of capital, and you can wait 15 years, and you'll make roughly 98%, 99%. That's what's going to happen. That's what it's designed to do. It's an insurance product. It's not meant to do well. It's meant to decay over time and then have really short bursts of good performance. But obviously, traders don't trade that way. So looking at a chart of long-term buy and hold, great. You want to make 6% a year? Go ahead and short the VXX. Take your 300% loss every few years when it happens, because it will happen. Don't trade very much money, leave it a tiny amount of capital, and you'll make 6% a year on a tiny chunk of your portfolio while suffering excruciating drawdowns. That is, of course, ridiculous. I'm being facetious here. So obviously traders, when they're trading, they are regularly doing shorter term trades. Maybe not daily, but it's kind of the same thing in the end. So that's why whenever you see the short VXX performance, it will look something very similar to this. Whether it's daily rebalanced, weekly rebalanced for people, it all looks kind of the same. But of course, you have to rebalance your portfolio or you're going to get an unbelievably low rate of return. So this is just meant to pull on people's emotional strings. This is not what short VXX actually looks like. But here it is. This is buy and hold. Now, I do want to point out just super quickly, 100 is not the highest for the VIX. So, I mean, of course, we could go higher. You can see here, VIX going back to 1986, it did go to 150. It actually went to 172 intraday. So if you're actually talking about the VIX index, a lot of people think there's some type of ceiling with the VIX. There isn't. It's just a statistic. It represents what the market's anticipation, plus or minus, one standard deviation, basically, of what the market is going to do over the next 1 year. Doesn't make much sense to say it's going to go up or down 150% in the next 1 year, obviously. But remember, it is just a calculation. It is just a statistic. So the number itself can definitely go over 100. The VIX can go over 100. That was my point there. But let's do something a little bit better. So now let's go into the calculator and we'll test our friend's theory. Well, the 18 makes some sense, right? As we explained, the 18 does make some sense. And here's what it looks like. If you put that lower threshold in there, it's actually gotten significantly better. We're on to something here. Now, an 84% drawdown, obviously this is going to breach every single risk tolerance of all investors in the world. I hope anyway. I hope there's nobody that can watch their investments drop 85% and keep going, but at least you're moving in the right direction. And then you put the high cap in there, and now we're doing what the person said, 18 to 30. Here's the results. So it looks pretty decent. We're onto something here. And this is why backtesting and running these numbers, it's not specifically meant to be ran as an actionable strategy. It's just to give you ideas. So this is a meaningful test, even though, again, a 62% drawdown is a total non-starter. You have to do way better than this. But again, the calculator is here to guide people into their trading future. You take this, you use it as a springboard, you use all of your data, you crunch the numbers on all of your new ideas, add more to it, and eventually you might come out with a strategy that you really like. But the 18 to 30, 23% rate of return, absolutely nothing wrong with that. It's kind of in the ballpark. My short vol strategy is about 30% a year. And that's using the 0.5 leverage factor. So, of course, our strategy at VTS is far superior to this, and our drawdowns are less than half of this. So this is a non-starter. But the point is, I wanted to explain a trap that people are going to fall victim to. And this is really important. And I cannot tell you how many emails I've gone through with people and how many times I've had to try to explain the concept of curve fitting and overfitting, because it is a real danger. There's a million ways to make a backtest look good, but there's some real pitfalls you have to be aware of. And I want to point out one thing, and it's going to be just crystal clear to you what overfitting and curve fitting actually means. Why did the person say 18? And why did they say 30? Is this based on some overarching macro opinion of the market, like 18, that must be the right number because it's a certain percentage away from the mean? Or is it the result of curve fitting? Because if we just put this to 17, 1 point away, 18 to 30, 17 to 30, that seems like the same thing, right? I mean, 1 point makes no difference. Well, actually it does. The strategy gets completely blown out of the water, and now it's down 98%. This is curve fitting. The reason the person, and I'm not hacking on them, I'm just saying that the reason they came up with the number 18 is because if you use 18, you will avoid the volpocalypse. When the VIX index itself, the day before volpocalypse, on February 2nd, 2018, it was at 1731. So if you put 17 in your backtest, now you avoided the largest volatility spike in history, and there you go. or if you put it at 18. If you put it at 17, you've just invested for literally 20 years and made no money. One day, 1 point, that's curve fitting. This is the perfect example of why backtesting has massive limitations, because there's no reason 18 was chosen other than to skip this day. But it also is there to remind us that there is a reason why, for example, my volatility barometer, which I consider the best volatility metric on the market, there's a reason it uses 13 different metrics at the same time, combined in a certain way into the same metric, so that it is a single number that spits out what today's volatility number is, but it's using a number of different metrics at the same time. And I even included a link to the volatility barometer video. So you click that and it's going to take you to the video and explain exactly what I'm talking about. But there's a reason for that. It's because certain metrics like the VIX might have missed Volpocalypse. As you can see, glaring mistake. If you were trading based on the VIX, I would say before Volpocalypse in February 2018, there's no way you would have used 18 as a number. You probably would have used 13, 14, something around there. The low end threshold makes sense to add that in there. Again, I agree with the general premise, but this is what it would have looked like, and you would have been destroyed, right? That's what would have happened. In live trading, real time, using the VIX, you would have been devastated. But you got to remember that if you look back, I think it was backwardation of 4.16, if memory serves. So if we go to 2018 on the VIX futures, go to February 2nd, yeah, you can see the VIX futures down here were in backwardation minus 4.16%. So if you were a person that was using the VIX index, you just traded for 13 years straight and you blew up your account. If you were a person who was using the VIX index and then you were using the VIX futures as a cross signal, say if the VIX futures are in backwardation, you're also in cash. Even if the VIX is below a threshold, now you use two metrics at the same time, and all of a sudden you caught it because you would have moved to cash. Of course, no short vol trader who knew what they were doing lost money during Volpocalypse because the VIX futures were in steep backwardation, and that is the most glaring, obvious red flag there is, really. So the point being, curve fitting is a real problem. People fall victim to it all the time, where they're basically data mining the exact right numbers, right? They'll go in there and they'll go for hours talking about this. Oh, 1730, damn, those results are terrible. I wonder what it would look like if I did 1732, Oh, boom, there you go. I just solved the problem. Now I've got this incredible strategy. That's not how trading works. Of course, there's no reason why the market is going to behave the same way going forward as it did in the past. It might rhyme, but it's certainly not going to be at 1731, right? Another Volpocalypse is coming at some point. It won't look the same. I've had videos talking about why that'll never happen again, but there's going to be a totally different Volpocalypse for a totally different reason. And when it happens, the VIX is not going to be at 1731. So curve fitting is a disaster. Of course, there is a way to go through Excel, and you can even use optimizers, so you don't even have to do it manually. It just does it all for you, and it spits out the perfect number. But that is not an actionable strategy. That's not what backtesting is about. Backtesting is there to give you ideas, and then when you put it into action, it's live trading that's really going to determine the success. But secondly, of course, the reason I'm going through this is there is a reason why my volatility barometer is so comprehensive, is because we just simply, as traders, cannot afford to make mistakes like this low-hanging fruit mistake that would be made. We just can't afford it. Investing takes place over 20 to 30 years, not 6 months. You can't do this. You can't invest from 2004 to 2018 thinking you made a bunch of money. You send your kids into a good school. You spend a little extra money on your vacations because you're making 20% a year. You're basically navigating your life with your budget, thinking that you're this, I got it covered. I don't even really need to worry about retirement. I make 20% a year. You make one little mistake and now you're back to zero. But you've already spent all the money. Your kids have already gone to the $30,000 per semester school, and you've already bought the fancy cars for 10 years, and you've all done that. And then you come crashing back down to earth and realize, oh, It was just an advantageous market period. I actually wasn't a genius. I probably shouldn't have wasted all that money along the way, right? So we use a broad base of metrics, measure everything, and of course, diversify across multiple different strategies. But I wanted to show everybody, that calculator is in there and it will give you some good ideas. Once you go through that calculator and run the numbers, you'll realize why people like me who have been trading volatility for 20 years, why we understand this concept of bookending, right? There is nothing wrong with the stock market or short volatility or crypto or utilities, real estate, all of this in that mid to low volatility range. Nothing wrong with buy and hold during that range. 65, 70% of the time, the market does just fine. But super low volatility, you start to lose, basically market running on fumes. There's no reason to be allocating capital to something that has no edge, right? And certainly cutting it off at the top and moving to safety. There's a lot of people who still don't understand this concept. So that's why that calculator is there. Run the numbers and you'll see exactly what I mean. Because there's actually people who still try to do the opposite. When volatility goes to 30, that's when they pile into short volatility. Well, sure, that works 80% of the time. 4 out of 5 times the market crashes. When the VIX hits 30, the market's pretty much ready to bounce, right? There's going to be a good news headline. Trump's going to change his mind and the market's going to go right back down. And you're going to feel like a genius because you called it perfectly. Oh, I've got a system. VIX goes to 30, pile into short vol trades. It's easy money, right? It's an ATM machine. Well, 1 out of 5, no. VIX gets to 30 and it keeps going to 50. And then it keeps going to 70. And once every 10 years, it goes over 80. It went over 80 in the financial crisis, went over 80 at COVID, right? Went over 150 during the Black Monday crash. Leave it up to you to whether that could ever happen again in the modern markets, but it is what it is. So yeah, you have to understand the concept of contrarians will eventually blow up their accounts. And that calculator that I hope all of you are going to go download for free is going to teach you that lesson. And then, like I said, every few months I will update the spreadsheet and I will add more interesting things to it. But that is interesting, right? Just changing it by one single point made you an extra 20% a year. Amazing. This is why whenever I see people talking about their amazing backtest, I don't mean to belittle people. I'm always, the positive person as best I can be, but I am also there to be the devil's advocate and the voice of reason. And I'm usually the one saying, live trading and backtesting, these are totally different animals. It's not that I'm uninterested in your backtest. It has some useful information in it, but I would estimate, plucked out of thin air, 99% of backtests, and as soon as you start live trading them, probably going to encounter some problems. So play around with that calculator. I like doing stuff like that, and it's there for you. You need the volatility data if you want to have any success in the future. You can't be that guy who just wakes up in the morning, trusts his gut. Oh, I feel like this is going to happen today. No, we got to put some numbers to this. We have to put some rules in place, some systematic rules to follow. And without a spreadsheet, like I said, you're bumping around in the dark. You're trying not to stub your toe on the way to the bathroom. So get the spreadsheet, trust me, and then ask questions about it and we can expand it and do videos. All right, that's it. That's my spiel. Hopefully people enjoyed the little rant there. And let's get into a few questions. Okay, I already see one. I'm tempted to go straight to it, but I'll have some patience here. We hear you. Thank you. Maybe it's just because nobody's tuning in, because I'll just do a little side rant here. I was in France for the last few weeks, and actually I should probably mention really quickly too that I'm not the type of person that shares pictures on social media and tries to do the, braggadocious posts about how here I am spending all this money in foreign countries and it's because I'm a great trader and subscribe to VTS. I don't do that kind of thing. So I didn't share any pictures. I didn't post anything. But there are VTS members who actually email me all the time. They're saying, well, hey, you should share more of your own personal life. And so the introvert in me is like, no, you don't need to see that. But the sort of the community member in me is I understand people probably want to learn a little bit more about me and see the travels, because the wife and I do go on. We're always on the road somewhere. We travel many, many times. So I'll find a way to slip all that in. But my original point was I've been in France for several weeks. I haven't really posted much on the YouTube channel, and live streams are great, but it's really the individual videos that get people coming. So it's very possible that we have lost a few people who thought I just kind of disappeared off the planet. So the goal now is to do what I've done many times before. I tend to start on YouTube. I have to basically rebuild the channel again. And so I'm going to be putting out regular videos again and just picking up where I left off. And over time, more people will come. So that is one way to say in the next few weeks, until we start getting our regular numbers again, you could probably get all your questions answered and it'll feel more one-on-one. And then, so tune into the live streams and ask me anything, because I will certainly, hopefully don't miss it. Where do we download Excel spreadsheet? Yeah, like I said, I don't know if you asked that before I even logged in, but all you do is just go to volatilitytradingstrategies.com. That's my little ghetto designed website here. It's terrible. I'm not a web designer. I didn't hire anybody to do it, but go to the subscribe tab, claim the 2-week trial. You're already in the community. So for you, all you have to do is in the daily email, you just go down to your video library, right? Click that, and it will take you directly to the VTS course library. And all the courses are in there for you, right? These will all be in there, and you can just watch all the courses, and they keep track of your progress. So I could use the welcome package. So if you're new, this is the package that you'll get. It's basically 14 daily emails. But if you go down, you can skip straight to day 13 or 14, by the way. Which one is it here? Volatility data spreadsheet, day 13. You can jump to it on day 1, but you just go in here and there is a video attached to it.
So how are you going to be a successful volatility trader if you don't have the underlying data?
Yes, how indeed. This guy's really smart. You should listen to him. It's about a 14-minute video, and you just go in there and you click over here on the downloads, and it will download it for you. I've tried my very best to keep the spreadsheet as basic as humanly possible, right? There's no complicated formulas here. I don't like to do that because everybody in the community is at a different level. And if you're really good at Excel, I'm not great at Excel. I just know how to use it to get what I get done, but I'm not an Excel genius or anything. But if I try to make it any more complicated than it is, of course, I will just be troubleshooting constantly. So it's very, very simple. You just simply either, if you're not a member, go to the website, claim your 2-week trial, download it. If you are a member, just click the video library or your course library in the daily email. It's in every one of them, and log in and do it. So everybody should have this spreadsheet. And of course, take with a grain of salt, because that also means everybody should be subscribed to VTS at least for 2 weeks. You should check out my work. It's unique, and been doing this for 20 years. I kind of know what I'm talking about. So go ahead and do that. Yeah, this person probably immediately, everybody's staring at me like, what is this guy doing? 0 to 0? That's not going to show any data. And I'm all confused, like, oh my God, my spreadsheet's not updating. This guy's yelling at me. Hey, dumbass, you put 0. So sorry about that. Can't edit on YouTube, so you just have to watch me fumble around for 2 minutes. Do you think the unemployment rate will rise because of AI? And where do you think it will settle? This is the question of all questions, right? We are all, no matter what industry you're in, no matter what stage in life you're in, this is something that probably at some point has been keeping us up at night, right? I know I think about this. Now, from my personal perspective, I think it's going to be 10 years before AI can beat me at investing. I just don't. I think it's still a conglomeration of what's already out there. And my work is very unique. And I do think, again, take with a grain of salt. It's talking about my own work, but I do think it's better. Long term, I think I'll just come out ahead, all the time. Short term, anybody can win. Some strategies lose. Not everything works in all environments. But yeah, give me 20 years. I'm going to crush most people out there. 99.9% of hedge funds. that's what's going to happen. So I kind of equate it, sort of little off tangent, little golf analogy, because I was a professional golfer in the past. I was always the type of player that was just ultra consistent and managed my game based on not making mistakes. I literally went an entire season, 1998, that's a long time ago, right? I'm very old. 1998, I competed in probably, I think, about 40 tournament rounds that year and didn't make a double bogey the entire year. Didn't have a double bogey. I've played 9 competitive rounds in a row without a bogey. So bogey free for 9 straight rounds. Actually, 8.5. It was 10th hole on the 9th round. I made a bogey. But I was always the type of person that, after, golf tournaments are 4 rounds. After day 1, I'm probably not winning. I'm probably not leading, right? Anybody out there can beat me in any single round of golf. I was nothing flashy or special. I didn't bomb it off the tee. I wasn't Rory McIlroy, but I was just ultra consistent. So at the end of day 1, I'm probably top 10, top 15, whatever it is. End of day 2, I'm sort of working my way up the leaderboard. End of day 3, I'm probably in the final group or getting close to it. And day 4, there were very few people that could beat me over a 4-round tournament because I manage my errors and I just need more time, right? So the harder the golf course is and the longer the tournament goes, the more likely it is that I was going to be the winner. So I always used to wake up in the morning, open the window in the morning, I'd wake up in my bedroom. I had the window right there. I'd whip open the window and hopefully it's pouring rain. Hopefully it's below zero. Hopefully, because I grew up in Calgary, hopefully it's snowing. Like the harder, the better, because I know the harder it is and the more time I have, the more people I'm going to beat, right? On a sunny, warm, 30-degree day on an easy golf course, there's 150 guys who could beat me. It's no big deal. On the worst conditions possible, no, you're not winning after 4 days. And that's kind of what my investing is like as well. So let me try to gather my thoughts why I was talking about all this. But essentially, for me personally, right, I don't think that my industry, at least the way that I do it, is imminently threatened by AI. I think that there's 2 stages going forward. The first stage is it's going to be a pretty long time before AI even has a competitive, back test that can outperform what I have done over the last 15 years. And then the second part of that is because I am a business owner, right? I'm a trader at heart, and I've been doing that for 20 years, but I also run a business. It's going to be a while before people trust AI over real people to do their investments. Even if AI can flash you a cool back test, it's not me, right? It's not based on 20 years of my personal live trading. So that's a long roundabout way of saying, for me personally, AI doesn't seem to be an imminent threat. I'm not overly worried about my own job. Generally speaking, yeah, this is going to be a problem. Now, the interesting part comes because there has been disruption throughout all of humanity. And so the question becomes, obviously AI is going to disrupt employment. It's going to just upend the board and it's going to change everything. That doesn't necessarily mean unemployment rises, does it? Because what if we just all shift into other career paths? We don't know. Maybe unemployment goes down with AI. Now, I tend to think it'll probably spike and then we'll figure it out. So there'll probably be like a 3 to 4 year period where it's kind of like red alert, DEFCON 1, everybody's getting fired or replaced. And then we'll all kind of figure it out. So if you're genuinely worried about this, my only tip to anybody is you want to be the type of person that can succeed no matter what the world throws at you. This is the skill set. Like if you're an accountant and you're great at accounting, you can be replaced very easily. But if you're great at accounting because you have a set of skills that does work with accounting, but it also works with 10 other things, well, now you're going to be okay. You're going to figure it out and you're going to go off in your direction and you're going to figure it out. You're going to take care of your family. So that's what I would say is what people want to do is they want to work on their broad skill set. You want to be the type of person, and again, I can only compare with myself, but for me, for example, it's really important, of course, that I stay connected to the investing world like that. But it's also very important that I stay connected with my skills of being on camera. It's very important that I stay connected with my skills of organizing information within my business and within my life in general. It's important that I build a network of friends or connections at the golf course. It's important that I maintain my physical health. It's important that I'm like prepared for the world in 10 different ways. And then AI is going to have a much more difficult time crushing you. But if you're only good at one thing and you're really average at everything else, yeah, AI could replace your job and you might be in a little bit of trouble. So you need to be what they would call anti-fragile. You need to be the type of person that AI's coming, bring it on, right? I don't care what AI does to the world. I'm going to be one of those people that succeed, right? Because even if AI just changes everything, there's going to be 5 or 10% of the population that are just fine and thriving. Be one of them. I don't know if any specific job is going to stay or go, but I do know that there will always be a place in the world for anti-fragile people with a multitude of skills. That's going to be a guarantee. So that is, obviously get to work, have discipline, don't waste time. This is another thing, like side tangent, but there's another reason why I haven't played a video game in 30 years. I spend my time working out, and hanging out with my wife. That's it. I have a very broad-based skill set, and I would recommend people do the same. So for you, my friend, you need to launch a website. Even if you don't have a business, launch a website and build it. Figure out how to do that. Not building it. AI can do that in 10 seconds. But I mean, manage it, upload articles, do that, get on camera, start a podcast, talk about something, anything, talk about, whatever it is, looking around the house. It doesn't have to be something you're a genius at, but just get into the habit of building your online reputation. Get on social media and use it correctly. Don't fall victim to the vitriol. Don't go down the rabbit holes of conspiracy. You want to be that person that is building a very broad-based skill set. And then you're going to crush it. Doesn't matter what AI does. Who cares? Yeah, AI is going to change the world. So did the printing press. So did the television. So did the space race. So did, everything. It's constantly changing. Everybody who's alive always thinks that their generation is the one that changed everything. It's not. The world's a constant moving target, and you just want to be that type of person that you're going to crush it no matter what happens. All right. Great talk today. Thank you. Thank you. I noticed you updated your performance stats as well. Looking back to 2022 onwards to today, can you give a high-level review of the portfolio performance? So I'm going to talk about something here very specific to this quite soon, and I'm going to have to dance around it eloquently a little bit because, of course, I have in the last 5 years, I've made one glaring mistake in my investing. I've made, I would say, 2 minor errors, and I have just been the victim of a certain period where a couple of my strategies underperformed. So I'd rather save it for the blog article and the video that I'll do, but I don't want to leave everybody hanging. So what I'm actually going to end up showing is the VTS portfolio with and without options. Let me just go back to, I hope it pops up here, or this is going to be annoying for everybody. Because it matters, right? So what I'm going to do is I'm going to show the VTS portfolio as it is, right? We've made 21% a year for 14 years now. Excellent performance. But the last 3 or 4 years has not been up to the same speed as the first 10 years. And then I'm going to show the results of just the 3 tactical strategies, removing all of the option trading. And I think this will answer your question. I'm hoping that blog, I will find a way to say, I'm not trashing the option strategies. It just so happens that the last few years, they have not performed well. So as an example, my Iron Condor strategy, which entered the portfolio in 2012, it was one of the original strategies. It made 17% a year for 12 years. And the last 2 years, it's down 3%. And it has a 25% allocation in the portfolio. The volatility trend strategy has not been in there the whole time. It's only been in there maybe 3 years of the term, but it's been there recently. And volatility trend has been a very consistent performer for me for 12 years. The last 2 years, it's flat. So when you look at the VTS performance and you break it down into our three main tactical strategies, and then right now it's 25% options, but at different times it has been as much as 30, it has been as low as 10. But those types of market neutral strategies, vol trend and iron condors, have just sucked for the last 2 years. And it's dragged performance of the overall portfolio down. So in a nutshell, I would say it's that. Not pleased, but it's totally normal, right? If those 2 bad years out of 14 would have happened in 2014, 2015, and now we're in 2025, we'd look back and say, oh, those 2 years sucked. But, it's been great for the last 8. You never really know what market environment you're going to get. This is why we trade many different strategies and we have rules, and then we just keep at it. We just stay consistent because you never really know what you're going to get. So I wouldn't call that a mistake. The one glaring mistake, of course, is that I moved to cash during COVID, right? I somewhat panicked. This is just not a trading panic. It was a managing a community of people panic. That COVID stuff, I cannot even tell you how many emails I was getting. I was getting overwhelmed, hundreds of emails a day, and people were terrified. And I decided in February 21st, to move the whole portfolio to cash. And as it turned out, that next month, our portfolio, if I just stayed the course and stayed with the strategies that have got me all this success over the years, break your own trading rules, bad things happen, we would have made over 50% in that 5-week period. So the results would look remarkably higher if I didn't make the one glaring mistake during COVID, and then the one sort of unfortunate reality that market neutral iron condors have just been flat for 2 years, and it's a pretty big chunk of the portfolio. So that's what I would say. Defensive rotation. Let me just pull these up so people know what I'm talking about. Defensive rotation, I don't know what it is. I don't sort of remember everything, but I know in 2023, it was probably up 90%. Last year, it was probably up 30%. It could very well be up 40% a year in the last 5 years. I don't really know. Tactical volatility is doing fine. Strategic's doing fine. Tactical rotation itself is totally intact, right? It's not been amazing the last year with SVXY, but yeah, this strategy's absolutely killing it. But unfortunately, when you've got 25% of the portfolio dedicated to something that has made 0% for 2 years, it's kind of a problem. It does drag things down a little bit. It hasn't been terrible. That's investing. It's ups and downs. Like I said, I'm a golfer who will succeed long term. I'm an investor. If you give me enough time, I don't think very much, if anything, will beat what I'm doing. I believe in it that strongly, but that certainly doesn't mean that it's going to be every year. It's unfortunately, we had a losing year in 2022, down 20%. Yeah. 2024, 2025 sucked for short vol. The last 2 years have sucked for iron condors. Yeah, it's not been great, but it is what it is. But like I said, I will do sort of an analysis of that and explain tactical volatility strategies are there to perform well in difficult markets, and they have. So, but allow me to save that for more organized thoughts. They meaning market makers balance out each other side pre-market. But which is better for them, calls expiring in the money or puts by expiration? I apologize. I don't know what this means. Usually when I don't know what something means, it means it's an internal conversation you're having with someone else, or my software isn't showing me all of your previous questions. Because from my end, I'm looking at it, and this is the first, yeah. I think I missed this one, but I think yours struck out. Yeah, I go back, but I apologize. I don't know what this means. So you're going to have to try again. Apologies. It's probably on my end. I just can't see your previous statements. My stupid eCam software, I love it because it makes my MacBook easier to use. I hate PCs, and I hate OBS software. So this eCam is really awesome, but it does actually skip some questions. All right, let's get to this one because I said, I don't I want to answer this one. Better long VIX around 16, isn't it? This is why you need to download the spreadsheet and see, right? Because I understand, right? I totally understand the temptation to be a contrarian style investor. So let's say you're short at 12 and you're saying better to go at what did you say? 19? Long volatility, long VIX around 16. Okay, that is interesting. So where are you short? Let's just say zero. Let's just say you have no lower threshold. I've never seen what this looks like, but I'm guessing it's terrible. Yeah, this is not good. This is 4.4% annualized with a 73% drawdown. The reason that drawdown is happening is, like I said, if you're going to be a contrarian, right? If you're going to be that person that goes long volatility when the market is stable, you're going to bleed tons of capital because the market can stay calm for much longer than you think. It can last for many months. And everybody's like, I can't believe this volatility spike isn't coming. I'm loading the boat on UVIX and UVXY, and I've got VIX calls, and they're just bleeding down every day. When is the market going to crash? When is it going to spike? The debt is this, and Trump's a disaster, and all of this. Shouldn't the market crash? And it just won't. And then Trump and tariffs come out. And shouldn't that just destroy the economy? Yeah, it should, but it didn't. And now here we go. So these contrarians, they just bleed capital week after week, month after month. And by the time you get that epic VIX spike that will eventually come, you've bled so much capital, you're not even back to break even. Like, you would need Armageddon just to get back to break even. That's the one end. And the other end is, if you go long volatility too quickly, yeah, it's going to be a problem. 16, I mean, I hope I'm reading this right. Didn't miss anything previously, but no, this is aggressively contrarian. Like, if you were to say something, in the 25, 30 range, you can kind of see it. I would still even go way higher than that. I only go long volatility about like 3% or less of trading days, because everything else is just, it's just too risky. You just bleed capital. Like I said, 4 out of 5 times the market bounces. So no, you don't go long volatility quickly. You want to few and far between, very, very sparingly. Okay. Here we go. Continuation maybe. As there have been no new trades recently, right? We have just kind of, obviously, again, I want to highlight the fact I am not a contrarian investor. There is no reason in the world not to be short volatility for the last little while, right? We're not going to take any new trades. We're just going to ride the SVXY. We're just going to be 2 times NASDAQ and just in the SPY. I am not a contrarian. I'm not going to be changing positions because I'm anticipating, the market's pretty stable. I think now's the time I'm going to go ahead and go into gold, or I'm going to go buy long vol or something like that. No. So yes, agreed. We have not taken any new trades recently, other than the options. We've done a new calendar and we've done a fairly recent iron condor. Can you suggest a weekly option trade so we can deploy some cash instead of just sitting in box? If you follow VTS, you currently have no cash, correct? Now, I do recall an email from you where we discussed this. Should you allocate now, or should you wait for the next fresh new position? I suspect this answers my question. You are waiting for a fresh new position. So you are in cash. Let's just assume you're in cash. The VTS portfolio is not in cash right now. Yeah, I can suggest something. The problem with suggesting trades is I don't like to just do these little drive-bys where I just say something and then don't kind of revisit it afterwards. But there's one strategy that anybody who's been following me for a little while knows that I just do basically on repeat, is I sell put options on VXX and UVXY. And the reason this type of trade works, God, there's going to be a whole course on this. Again, like I said, I don't like to do these little drive-bys. But if you sell something for a 1% return, we'll say, for a weekly contract, so you're looking for about 50 cents. So, you could maybe do that one, get a little less, but let's just say this one. If you sell a put option on VXX, right, the current price is here. the break-even price is here, and you only lose money if it goes down a lot, right? So I call this the wheel of fun. And if I get assigned, if the VXX goes from 44.84 down below 44 by next Friday, you will be assigned the VXX. You will be long volatility with the VXX. But then you turn around and sell a covered call, and you can see at the money covered calls do pay a pretty nice premium. So you can make some nice premiums selling put options. Usually they don't get assigned. On the times that they do, it means that you're going to sell something like an aggressive covered call. You're going to dump your shares, you're going to get back into cash, and you're going to do the whole thing again. And so let me just say that the reason this kind of works, just broadly speaking, is that there's also a very good chance, problem this doesn't apply to you, but there's a very good chance that the rest of your portfolio is going to be allocated net long the market. And the only way this trade loses money is if the market does so well and VXX bleeds so far, way beyond its normal levels, right? Remember, there is a VXX calculator here. It's not really expected to go very low based on long-term averages. But if it did, if it just epically crashed, yeah, you're going to get assigned the shares, but presumably the rest of your portfolio is going to be absolutely crushing it, right? So you don't really care. It's considered an offsetting position. And then the only thing that I would always remind people of is, of course, the markets can stay low and calm for a very long time. So you want the covered calls to be aggressive, and you want to use a stop loss. So I would always use a 10% total value stop loss to where if it did get down into this range, then you're going to stop out. So one contract is going to be $4,400, 440, somewhere around there. And you just keep track of your rolling stop loss for the trade. And you can just sell put options as much as you want, and then just keep track of your stop loss. And eventually, if it does happen to get there and your cover call premium didn't quite cover it as it was bleeding down, then you just stop out and you rinse, repeat. But the Wheel of Fun is just something that I do every week, aggressively. And it's great because, as I've always said, net long market strategies that do well when the stock market is performing well, they're a dime a dozen. Nobody needs more net long equities exposure, right? If you go on Twitter, everybody and their dog knows how to make money when the stock market's going up. That is not the skill set that you need in this market, right? Obviously, you need the skill set of a truly diversified portfolio with different strategies that have different exposure. And the key is that they can both make money at the same time. Right? There's that overlap area where if your VXX trade goes miserably, the rest of your portfolio just crushed it, right? Far more money was made on the broad portfolio than you lost on the VXX. If the market doesn't go up, then the VXX trade by very definition makes money every time. What you're looking for is that middle ground where both your portfolio and the VXX is just bleeding down, but it's not bleeding down fast enough that it's outpacing its long-term average, and you can make money on all your strategies at the same time. But they are technically offsetting opposites. That's the key. So give that a shot. Take that little 4-minute spiel and do with it what you will. Sell one contract to VXX or UVXY right now today. Let's do it. Let's load it up and do it. So what did I say? We are going to do the VXX 18 July. We're going to sell, nope, that's gold. We're going to do VXX. Like I said, I mean, if you're talking about 1% a week, that's a lot. 0.5% a week, that's still totally acceptable. So in this case, if you were to get 21 cents for this contract, that's 0.5 a week. Right? Remember, there's 52 weeks in a year. So that's still, if you don't get assigned and you just happen to have 52 straight weeks of wins, you made 26%. But remember that the strategy makes much more money on the covered calls when you get assigned. So if you happen to you bat 1,000 that year and you get 52 perfect trades, you made 26% that year. If you happen to get some that get assigned, which you will, I've never gone a year without getting assigned multiple times, but then you can actually make some pretty good profit on the way out the door. But let's just say that you're going to initiate your position with a single contract. Let's try to get 20 cents. Let's do our 30-second rule. Remember, there's nothing wrong with trying to get more, but I don't nickel and dime trades. So go a little bit above the mid, 21 cents. Let's see if we can get a decent price. There you go. I got it. And then if I didn't, I would have waited a few seconds and adjusted it. They're computers, they adjust quickly. So now what are we looking at? Well, we've got a live VXX trade, Wheel of Fun, number one, right there. Like I said, 440 is going to be my stop loss, somewhere around there. And the price is right there. So there you go. I've got one. So I'm going to make $21. And what I typically say about position sizing, somewhere, of course, your risk tolerance applies, but somewhere around 1 to 2% of capital seems to be a pretty decent ballpark area. I've gone as high as 10, 20. Honestly, I really love the strategy. But if you're just starting out, that's totally fine. So, if it goes perfectly well, you're going to be making 21 cents on a $44 contract is 0.48% for the month. So almost 0.5. You're going to be charged, in toss, you're going to be charged 65 cents for the trade fees. You're basically looking at 0.5% this month. Now, I could have gone down to the 45 strike and made twice as much, but then, of course, the likelihood of getting assigned is 1 point on the VXX more likely. So it depends how aggressively net long your portfolio is. To be honest, right now, because my portfolio is short vol, 2 times NASDAQ, and long the SPY, I probably should have gone to the 45 strike. But yeah, we'll revisit next week. I just do this over and over. I've been doing this for years, like literally probably 14 years now. I've done thousands of these trades. I am perfectly comfortable. I don't want, again, drive-by trading is never a good idea. Oh, just do this, and then I'll never revisit it again. I'll be one of those guys that only if it wins, I'll come back on Twitter and say, hey, remember I said that? If it loses, we'll just bury it and I'll delete the tweet. I don't do those kind of things, but I am extremely comfortable with this strategy. I know a lot of people freak out because they're like, doesn't the VXX always go down? Like, this is crazy. You're selling put options. It just has a way of, the covered calls along the way can be sold very aggressively. And with a 10% total value stop loss, there's really nothing bad can happen. I'm totally comfortable doing this. So give it a shot. It's just one of many, many things you can just do on repeat over and over for the rest of your life. All right. I probably should wrap it up here. I've been yapping a lot today. That's my entire life. But in past videos, you mentioned the VX30 to VIX roll yield as a basis for your portfolio selection decisions. Correct me if I'm wrong. Half right. Isn't that better than using the VIX? So VX30 to VIX is, in my opinion, a top 5-ish metric, specifically for volatility ETF trading, because of course that's how they function. They function based on the M1, M2 VIX futures in relation to the number of days they have to expiration. So contango backwardation technically means nothing at all, but when you factor in how many days to expiration, then it starts to be a very meaningful metric. And if the VX30 to VIX goes down, it means VXX is also going down. That's what it means. Directly, like mathematically, that's what it means. So it's great. It's a top 5 metric. And then the second part, isn't it better than the VIX? Yeah, miles better. Absolutely night and day difference. If you start using actual metrics that really mean something, like our cash VIX oscillator, for example, I don't like to mention these things because I'm not going to tell you how I calculate it. It's just proprietary to me. Our volatility barometer, I'm not going to tell you how I calculate it, but these are far superior to something as dumb as the VIX. Like the VIX is such a hyper-specific thing, and it doesn't even, it's not even a directional indicator, right? Remember, the VIX only is a statistic based on S&P 500 options activity of the plus or minus movement of the market. It is directionless volatility. It's just variance from a mean. So there are times when the market is screaming higher and the VIX can be high, right? That can happen. Of course, volatility is just volatility. But the VX30 to VIX roll yield, that's not an ambiguous signal. We know exactly what that means because it's literally in the formula for how the VXX moves day to day. So yeah, you're just insert your go straight to the horse's mouth analogy here. Yeah, obviously go to the better metrics. The VIX is just something everybody knows about. Everybody talks about it. Of all the volatility questions I get, I guarantee you 90% of them have something to do with, hey, the VIX did this. What's the trade? Nothing. The VIX doesn't mean anything. But in combination with other things, it starts to matter. So yeah, VX30 to VIX roll yield, 100 times better than the VIX. Historically, VTS used 5 strategy components. There's been more than that in the past. Now that there are 4 components, when and why do you retire the 5th strategy? Well, for me, there's no retiring of strategies. Like, my job is sort of twofold. You only see the one side of it, but designing strategies that on their own, stretched out over a 15-year period, are going to outperform the market. And remember, when I say outperform, it does have to be significantly. It can't just be by 1%. It has to be by at least 2%, but probably 4 to 5. Every single strategy that I trade beats the market over 15 years. Some of them get destroyed by the S&P 500 over a 3 or 4 year period. That totally happens, right? Not every market environment is designed, no strategy can just slam dunk in everything. But that's the one job that I have, is that I don't trade anything that doesn't have an expectation over a 15 or 20 years to just destroy the market. Typically, it's because of drawdown reduction. But that's the one end that I see. I see all my suite of strategies. My second job that you would see is what makes it into the portfolio. That's where we have some wiggle room to say, well, in this specific market environment, it doesn't make much sense to put this strategy, so that one's removed. Some of them come and go. Like, since I launched, we've had conservative vol. We've had aggressive vol. We've had tactical volatility. We've had the volatility trend. We've had Wheel of Fun was in there for a while. I've had some earnings trades that were officially in the portfolio. I've had, a suite of option strategies that have at some point, peaked in and had something to do with the long-term official track record. That track record is live trading of absolutely everything that I've ever sent out in an email, right? So it's official. But that doesn't mean that everything is in there all the time. I still have the ability to move things in and out. It doesn't change the track record. Like, let's say today, I actually have an article on the website. Like, this is live trading. My track record is 100% live. Let's just say, for example, next Monday, I remove iron condors. I don't go back into the track record and say, hey, what would it look like now? And I just show that. No, iron condors have been in there for 13 years. The only way that I wouldn't do that is if I was specifically talking about tactical rotation. Then I can remove iron condors because that's an option strategy. But no, tactical balanced was in there up until not that long ago, a couple years ago. Where's your question? That's not it. Historically, there it is. So it's really nothing that took it out. It's just the volatility trend strategy was A, not doing well. It's been flat for 2 years. And B, people didn't like it, right? I just got a billion email questions. So what I'm going to do is I'm just going to make a video course about it and put it at VTS options instead. It is an option strategy. So what I'm trying to get to eventually, certainly at some point this year, hopefully sooner rather than later, is to get back to what we used to have: VTS, tactical rotation, and VTS option strategies, right? I'm trying to get back to that. But I just got so busy a few years ago managing 2 communities that I just had to triage one of them, and there you go. VTS made it, VTS options didn't. But it's coming back, and when it does, I will move anything that's options over to there, and we'll just keep 2 separate communities again. I have figured out ways in the last year or so to really streamline everything and to reduce the emails and to, make sure that I have time to manage both of them. That wasn't the case a few years ago. So yeah, you're going to see the portfolio change again, probably in the next couple months. It's not, don't hold me to this. It's possible that I just keep iron condors in there, maybe. But it would just be for convenience sake to just have entirely, oops, did I unmute? Entirely tactical rotation in one community and then entirely options in another. Because there's a lot of people that don't like the overlap. Every time I do a blog about an option trade, people roll their eyes. Like, I'm here for tactical rotation. And then when I was at VTS options, I'd send out something to do with volatility ETFs. And they're like, I'm not interested in that. I'm just interested in options. So I'll figure it all out. But just know that, yeah, this is portfolio management. This is my own money. I'm not doing this to look cool for a community. I'm doing this because this is where my money is. So sometimes I just don't feel like allocating my capital to a specific strategy. I stopped trading tactical balanced, for example. I just thought that capital was better allocated to tactical volatility. Just, what am I going to keep it in the portfolio because some people liked it? Some people liked it. It was a very popular strategy, but I don't want to put my own capital in it the last few years. I think that capital is better allocated, spread across defensive and tactical volatility. So that's what I did. Wherever my own money is, that's what you see in the emails. I'm not going to ever put something in there and say, well, by the way, I'm not actually trading that one, but I know you like it, and maybe you'll keep paying me money every month if you like something, but I don't actually trade it. I don't do that. I just decided when I started VTS all the way back in 2012, I will only ever show the portfolio that my money is in. Nothing more, nothing less. I will not market things that sound cool, even though I don't trade them. So, there's many bandwagons that I could jump on and get a lot of followers and get a lot of people paying attention to my work. But if my money's not in it, you're not going to see it. That's the promise that I made to myself, and I think I owe that to the community. So yeah, strategies, it's not a revolving door, but strategies do come and go. Every few years, the portfolio might look different because, like I said, you got to keep going with all of your strategies. But at the same time, I'm not dumb. I've live traded them for 15 years and in some cases almost 20. I know what the landscape looks like and which ones have a higher or lower probability of success. Under Trump, there's just a few strategies that just won't work as well. So, yeah, hopefully I answered something in there. I think I talked enough. Short SVIX and wait for a crash or recession. I don't love it. Have you plotted the long-term performance of short SVIX? It's not great. You've got to be aware of that. It's not great at all. So be careful with that one. And especially since there's so many ways that you can just apply some very simple rudimentary metrics and save yourself a world of pain. You don't have to buy and hold anything in this world. It's just ridiculous. If I just tell you, you say short SVIX and wait for a crash. Short SVIX when the VX30 to VIX roll yield is above 0 and wait for a crash. I just made you an extra 10% a year just with that. Like, that's what I'm talking about. It's really not that difficult to improve on these basic things. So don't handcuff yourself to hard rules like that. I know I'm probably reading way too much into this. There's really nothing there. You're probably like, well, I didn't mean that. But you get my point. Is there's some pretty low-hanging fruit that you can improve. This is a good one. This will be the last one, and then I definitely have to go. Do your members get access to the historical data of your proprietary indicators? No, they're proprietary. The last several years of daily VIX barometer readings. That's the one, like, I won't share the VIX oscillator. I like that metric, and I've never in my life seen anybody else with anything even close to it. So I do love that one. That's just staying in my own pocket, and I'm not sharing it with anyone. There's a few like that is just, it's mine, it's VTS. I don't watch anybody else's work. I don't, I do my own thing. That's why it all looks so different. I like to keep it that way. I don't want to share it around and then have the whole world talking about they're basically VTS knockoffs. I don't want that. The barometer is the only one where I might find some wiggle room because, yeah, the problem with the barometer is that it is somewhat the centerpiece of what I do. And technically speaking, and I've had a problem with copycats in the past where they subscribe to my service, they pay the $90 a month, and then they just regurgitate the signals to a community of their own. And this is not happened just once. This is something that it's been a problem. And of course, I'm just a subscription service and I live in Dubai. Like, what am I going to do about it? So I was made aware about a year ago that there's literally a hedge fund in Europe that's recycling VTS exactly. What am I going to do about it? Sue them from my home in Dubai, an unregistered financial advisor? I mean, I have all the certifications, but that's in Canada. Like, I could be an RIA, just like that if I register in Canada, but I live in Dubai now. There's nothing I can do about it. So the point is, the only offensive weapon I have is to not release so much of my information that it makes them look stupid to their own community, right? If they don't know the historical readings of the barometer, then when their members that are subscribed to some dumb knockoff service asks them a question, they're going to sound like an idiot because they don't have the answer. But if I start providing that history, well, now I've given them all the ammunition they need. Now there's going to be a hedge fund in Europe managing VTS, and they're going to be like, oh yeah, here's what we did in 2013. You see the barometer level, it was here, and that's why we moved to cash. And now all of a sudden they can start filling in the gaps. So I don't know if I'm going to do that or not. On the one hand, I would love to. On the other hand, you said it, proprietary. There's a reason you said that word. My work is mine. And do I really want to share it? Respectfully, probably not. So there's just going to be some things that you won't know. And got to keep it that way. But I feel like, and you can comment, you can tell me I'm wrong, whatever, but I feel like I'm pretty generous with the work. Like, if you find anybody who writes more articles, shares more free videos, and does more free live streams, I'd love to see it. In the volatility community, I'd love to see that person, but I'm not sure they exist. So I feel like on the one hand, I'm somewhat protecting something that people want to see. But on the other hand, I feel like I'm extremely generous with what I am giving. So it's a give and take. Hopefully people are happy with what I'm doing, and I will continue to do it because I love it. So let's leave it there. That was a long one. It was interesting. And like I said, I do hope people take me up on this, because while I don't want you to put an actionable strategy into place simply because your backtest looks good, I do think that there's a lot of useful information within all of your backtesting. And that is step one to get you further to an actionable strategy. So mess around with those numbers, give me suggestions on future things you want me to add, and I will see you all next week. Thank you.